as expected, and hence no great move. Still locked in close to 90 on Brent, and not far behind we have WTI. So clearly a strong market. One wonders, if I kick off this morning with Dr. Carol Napoli, CEO Crystal Energy, as always, Thursday morning anchor. Thank you, Carol. Is this a case of supply concerns or robust demand?
Good morning, Sean. Good morning, everyone. It's a bit of both. If you talk about the market situation today where prices are, we do have, it was more or less kind of expected because of the rebound we had since December after the fears of Omicron dissipated, when people realized, yes, it was more contagious, but it wasn't causing serious illnesses, and therefore we didn't go into serious lockdowns. On the contrary, you look around the world, you see even countries like Australia, which were very strict with their policies, are gradually relaxing their rules and going back to normal, and that by itself is lending support to demand. On the supply side, yes, you are expecting supplies to hit the market, additional supplies to come from within OPEC and from outside OPEC, led by the US, but those supplies are likely to hit after the first quarter of this year. So at the moment, we are in this situation of a stronger rebound in demand, and I want to call it tight supplies, maybe tighter supplies compared to perhaps what many expected, but I don't see we are in a mode of crisis as is being portrayed by mainstream media, especially when they talk about OPEC plus spare capacity running at historically low, which is inaccurate and incorrect. I think and that's why OPEC plus said it clearly that they remain cautious because they see the markets changing a gear as we progress into this year.
I'm not sure if that was a little dig at our next guest, but are you mainstream media? I think perhaps you are. That's where it goes. But let's welcome Clyde Russell from Reuters, who wrote a great column regarding the OPEC Plus decision and making more announcements on 400,000 barrels a day, but not anywhere close to meeting those. What is the consequence, you think, of that at the moment, Clyde, if indeed there is one, that OPEC keeps pressing the button on an announcement that is not really credible?
Well, I think OPEC has created a sort of a major problem for itself. I mean, it said it was going to lift output by 400,000 barrels a day starting in August. They haven't made it once. It's just, that's the same plain and simple fact. They have been underproducing. They like to call it over compliance, but let's call it what it really is. They're underproducing. So any tightness in the market is basically a product of OPEC. Yes, they're going to try and deflect this by saying, oh, Western nations and private companies haven't invested any money because of they don't want to spend money ahead of the green transition or that sort of thing. But the simple truth is the only people who can deliver oil on a short-term basis are the members of OPEC and Russia. They haven't done that. Are they incapable of doing so, or are they just sort of biding their time, seeing if they can push, how high they can push the price? I think the problem for OPEC becomes very simply, if the price does rise to $100 a barrel, as many on the sell side are calling for, I think that starts to have a serious impact on demand, especially in Asia. I think you'll find that even in relatively well-to-do countries like Australia, where I am, if the price gets to $2 a litre, $2 Australian a litre, it's about $1.80 at the moment for petrol, you're going to find that as a massive psychological barrier, and people are going to stop driving. They will do everything they can to cut down on consumption. But leaving aside little Australia, if you go to the big consumers, India, China, Japan, at $100 a barrel, their economies are going to get crunched. So I think it's OPEC really has to decide what it wants in the short term. Otherwise, it's going to suffer a lot of long-term pain.
Rustin Edwards, head of fuel oil procurement at Euronav, sitting in Geneva. Rustin, is this, again, your thoughts on supply shortage versus robust demand? What's driving this market, and how does that look from a shipping perspective? Is everything thundering along? Give me more oil, please.
Well, I mean, the Short answer is, based on the EIA data out last night, you have declining refinery utilization and consumer stocks of gasoline and jet fuel building. That doesn't sound like a lot of good demand in one of the biggest consuming nations of the world. Gasoline stocks have been building for the last 6 weeks now in the United States. Now, part of that is the seasonality of gasoline. It's wintertime, very few people are driving. You've had a couple of major ice storms hit across the United States. There's one impacting the mid-continent right now of the United States. So, weather is playing into a factor, but nevertheless, declining refinery runs, increasing stocks of consumer fuel is not a sign of strong demand. Now, if we look at the global picture for freight, freight has been on a downward trend for tankers since Q4 of 2020, and that trend looks like it's going to continue for the time being, as there's still too many ships for the amount of oil available in the market for export. There's been some shutdowns, such as in La Pampilla after the explosion of the underwater volcano that caused a major oil spill off Peru. And so you do have some capacity of crude that's not able to get out to market. Ecuador's had its own problems as well. They had a major landslide, which temporarily shut down their pipeline exports of about 220,000 barrels a day for about 3 days. And the geopolitical tension, I think, is the icing on the cake, which is keeping the prices where they're at. You pull out the issues on the Russian-Ukrainian border, and you probably see $7 to $8 come out of this market rather quickly.
Carol, perhaps the bigger story this week than the OPEC meeting, which is, as you say, pretty much as expected, has been the equity market's reaction to the supposed tightness that we're moving into in the central bank policy. The generally accepted narrative now of 5 interest rate hikes this year expected, starting with the Fed next month. But yet the equity markets have spit it out as a kind of a non-event now. It's bedded in, and let's get back to the races. Is that a miscalculation? How do you interpret that?
Well, you said it, Sean. You kept on using the word expect. So it's all about market expectations, and markets don't like surprises. So even if even whatever the development is going to happen may not be terribly in, for example, some investors' favor, it may have a lower impact than if you have shocks to the system. So, but we still expect to see a greater volatility because we're still not on a firm ground. You still have lots of uncertainties. The economic data coming from the US, let's say, on market sentiment, if you want consumers' confidence, is pretty discouraging. And when people feel pretty dark about how things are going to unfold in the coming months or year, they tend to consume less and they tend to be more careful with what they do with their money. In Europe, inflation, I was reading yesterday, it hit another milestone, and it was far ahead of expectations. But again, we've been wrongly calculating inflation. So I don't see the situation drastically changing. In fact, we have to continue to expect spikes to prices everywhere. Going back to oil markets more precisely, we have the geopolitical risk at the moment, though I have to say that today I feel more comfortable with the situation in Europe as I was, for example, last week, because you feel that there has been some kind of diffusion, some kind of toning down of the statements made by political figures, whether by Biden or even by President Putin in Russia. So it's still pretty fluid, it's still uncertain, but it's not as tense as it was a year ago. Of course, that can generate big surprises, and markets don't like this kind of big surprises, and that could translate into greater volatility and more spikes in prices.
I mean, just to come back to the point about expectation on the rate hike cycle, I mean, if I stand out on a highway and I know there's a truck coming, it doesn't make the consequence of that truck hitting me any less impactful, even though I know it's coming. I mean, 5 rate hikes is a significant, I don't know when the last year that happened, but nonetheless, it is a massive adjustment in the price of money and the consequences that drop off from that. My question again is, just because we know that's coming from an equity market point of view, from company profitability and so forth, does that make the impact less, the consequence disappear?
Well, it depends on the speed at which the truck is driving, right? When it's heading towards you.
It doesn't need to go very fast to knock you over.
No, I know, but look, I mean, people talk about 5 rates increases. They are not cast in stone. They have not been confirmed yet, and we're not quite sure when they are. How many rate hikes are going to be for certain? But also, we have to remember we're starting from a very low base. I tend to see the glass half full. I tend to see that the central banks are finally taking action to tame inflation, to treat some really structural disease that can derail economic recovery. So I wouldn't look at the interest rate hikes as necessarily bad news. Maybe they are going to correct what we have in the market, the scars of COVID-19. So that's how you would see it. I wouldn't just see it as a big truck heading in my direction at full speed. It doesn't have to be that dramatic. It can have consequences if, let's say, central banks don't pay much attention to the impact on economic growth, or they hike rates pretty high. The risk is there, but I do think it does. Risk.
I do think it does, however, raise, in my opinion,
You don't like the Fed, full stop.
No, I don't. I think they're incompetent, and I don't subscribe to the view that this is, expectation. I mean, it's only a few months ago they were talking about inflation being some temporary concept. So I don't think this is expectation. I think it is incompetence. And I think in order to get a grip on things, given the market reaction, they're going to have to do a 50 basis points next month. And I think that all of this disregard of the rate cycle is going to require the Fed to take control, but not to get distracted. Clyde, the Fed might be in a sticky wicket, but OPEC Plus finds itself caught between a rock and a hard place, I think, between its two biggest stakeholders, so to speak, at least OPEC rather than OPEC Plus. There was a little bit of kind of half joking that the meeting was only 16 minutes yesterday. I think that was probably just about how long they could manage to have a meeting without all of the issues coming on the table. And they wanted to rush out of the room because obviously you got Russia, you got all these issues that could come in to make it a very difficult moment for them.
Yeah, I think, what we saw with OPEC this week was a classic kick the can down the road. They just really didn't want to deal with the tough issues that they're facing. In some ways, they've got a short-term problem and a long-term problem. The short-term problem is oil prices are now at levels that your major consumers, importing nations, China, the US, would consider to be unreasonable. We saw last year they tried to tame that by selling from their strategic reserves. Not really something that worked very well, but it's something that they might try again. So you've got the short-term problem of there's a tightness in the market. Yes, demand is coming back. But on the other hand, as I think, demand tends to lag price increases by a few months. I mean, right now, people will be arranging deliveries for March, April. And are Indian refiners really going to keep buying at what might have been record levels in January? About 5 million barrels a day going to India. Are they really going to keep buying when prices are pushing $90 a barrel? The same goes for China. A lot of people talk about inventories, but they only really focus on US inventories and perhaps OECD inventories. Never any talk anywhere in the market about China. Now, I know China doesn't release inventory data, but you can make a guesstimate. I do it every month. I basically look at what they import, what they produce domestically, and what they run through their refineries, and I work out the difference. Now, China actually added to stockpiles last year. Not much, 170,000 barrels a day, but they weren't dropping their inventories. They've still got a massive amount that they imported in 2020 that's built up. The whole idea that inventories are low and have to be replenished is really just, to my mind, a sell-side construct. It's not actually a real thing. If I actually talk to people in the market, the traders who are focused mainly on Asia, the refiners aren't competing amongst themselves to secure scarce cargoes. In fact, it seems to be more the other way around, that the producers are offering discounts to get the refiners to take cargoes. This isn't a sign of a market that is, should be pushing $100.
On the point, Clyde, of sort of the outlook for China demand, China imports, obviously last year we saw the imports decline for the first time in very many years, but yet consumption still rose. What's your outlook for this year in that regard?
Well, a lot depends on how much China wants to export. And that's really an official Beijing-style decision. They grant the quotas, and they're for both crude imports and for product exports. If they are going to allow quite a high level of exports, then we will see the imports come in and rise quite a bit. That wasn't really the case last year. So, their product exports were down in certain categories, up in others, but overall were more or less the same in 2021 from the previous year. So, again, it all depends really on how much they're going to allow, that sort of trade to continue. You also do have some more refining units coming online, so I would expect that will lead to some imports to build up their commercial working inventories, but also, it raises the baseline. So I would expect imports will rise this year in China. But again, a lot of this is price dependent. I mean, you find a Chinese refiner that's happy to pay $90 a barrel. And in a market where they think the price should be closer to 70, according to what they see on the supply and demand fundamentals, they're just going to simply say, no, we're not taking crude. They might dip into those stockpiles a little bit.
Rustin, the big bad boogeyman of the sort of frigid winter hasn't hit Europe. Given all the stress that's in the European energy system, that's probably obviously a good thing. But ultimately, it's a demand weakness spot. We mentioned that China is a little bit vulnerable at the moment. The Europe isn't getting the winter from hell, is it?
No, it's not. We had a forecast for this week here in Switzerland of 0 to +1, and it's currently +8 outside.
Centigrade.
Centigrade, yes, sorry. Centigrade. So, it's a bit tropical for February, but nevertheless, and there has been some retrenchment in the energy supplies. I mean, Ukraine flows from Gazprom are near contractual levels of 107 BCM coming through the Ukrainian pipeline. So that further shows that, if you're going to invade Ukraine, why would you give money to your enemy? So the nat gas supplies are picking up. You've got the influx of ships coming in on an LNG basis. So that has put pressure on the LNG side and on the nat gas side to bring the prices back down to a more reasonable price level. They still have to build stocks, so we are running short. However, I think the biggest drag on the EU at the moment is the high distillate prices that are currently being experienced. Distillate cracks have been on a tear. Shell Pernis, a 400,000 barrel per day refinery in Rotterdam, has shut down 2 of their VDUs for 6 months as they convert themselves into a more green footprint, adjusting the refinery from petroleum to more biodiesel production and petchem production, which is going to be a trend that's going to be impacting, I think, going forward as the demand for biodiesels picks up more and more as people use it as an alternative fuel to petroleum.
Just Rustin, to pick up on the sort of log jams, supply chain log jams, California, China, where China is still quite vulnerable to an Omicron continuous lockdown, but any vulnerability there at the ports?
In the United States, port delays are still high. Port of Long Beach, 28-day delay still. Ships are waiting off 150 miles offshore. Port delays on the East Coast are running anywhere between 2 weeks now for the major container import ports. Prices are still fairly elevated on box rates. A 40-foot container from China to the US to the West Coast will run you about $8,000, which is still $6,000-7,000 over pre-COVID prices. To the East Coast United States, $12,000. So still pretty expensive, and that high cost of freight continues to roll through and puts that inflationary pressure on the consumer.
Let's get the survey result in, a question first before we have the results. This isn't elections in Syria. We don't know the result before the election. What is the survey poll question on this view of supplier demand pulling? Irene, if you could bring up the survey question. What is the bigger driver of oil markets currently? Supply concerns, robust demand, or evenly balanced? What is the view on this room? Where can this problem be fixed? Ultimately, I suppose, is the question. Carol, your thoughts on the sort of position that OPEC finds themselves in vis-a-vis the intersection point of the geopolitical backdrop versus their economic decision making. Obviously, they're locked in an agreement that was decided 6 months ago. That expires. We're already talking about March production, and then we're going into the increasing quotas in May. So this window of time in which they're caught between the two of them, how vulnerable are they, do you think, to this price point, impact on the demand going forward, impact on stability of the group?
First of all, Sean, I can tell you how happy I was to hear Clyde talking about inventories, because finally some sensible points made there about the level of inventories because of discussion that you hear today. Mostly they talk about tight inventories, but they're actually focused on the OECD. But when you look at the global picture, you may have a different perception. The same thing, another important point that I want to highlight, how fast OPEC is usually to responding to demand. And this kind of explain the kind of junction that you talked about. Of course, they are benefiting from higher prices. Any producer would benefit from that. And to that, I would like to add the US. Not we talk about the US as the largest oil consumer, but we forget they are also the largest oil producers. So they too are benefiting from higher prices, and we have to compare the impact on consumers and the impact on the government from higher prices from the production.
I mean, we saw this week
translated taxes, higher taxes as well, not only in the US, but also in some European countries where you find the oil majors, for instance. But going back to OPEC, so they are enjoying currently the higher prices, and they don't see yet cracks in the demand. The problem is that historically, OPEC tends to be late when the impact on demand becomes more notable, and they end up playing catch up. So at the moment they are in a good position, but that's why I want to refer to what I think it was the Saudi energy minister who kept on using the expression cautious. And in that caution, for me, I see the impact on demand. So they would like to see prices high enough to generate the revenues that are already having positive spillovers on their economies, which are hugely dependent on oil and gas revenues. But at the same time, they don't know for sure when will be the tipping point when we start to see demand slowing down, especially when you look at the macroeconomic data, the macroeconomic forecast for the GDP. Only a week ago, the IMF downgraded its forecast for this year. So that can have also some repercussions on demand. So that's why, and I also think that they are doing this kind of nimble approach, this monthly approach. And as you said, in April, they will have to revisit their agreement at a time when additional supplies are expected to come to the market, and maybe impact on demand becomes more noticeable if prices stay where they are today.
Clyde, the cycle of the year is such that, at least from the beginning, January outlook was that the first half would be tight and robust, but the second half would ease off. That's sort of contrarian to the China position, where the first quarter does look like it's going to be the weakest one, because they've got the Beijing Olympics now this week and other issues they have that will make demand perhaps a little softer in the first quarter. What does it look like beyond that from a China point of view?
Well, again, I think with China, we have to wait to see exactly what Beijing wants to do when it comes to stimulating its economy. We all know that they have growth targets around 6% per annum. They want to see that in their economy. The question is how they choose to try and get there. I think you're right that this quarter will be quiet because of the Beijing Olympics, and also because they have put in quite a lot of restrictions on some heavy industries. Now, they're not really oil consumers per se, they're more energy consumers in the form of electricity or coal. But what you are seeing is that level of activity is not, as it normally it starts to pick up a post-Lunar New Year. It might take a few weeks longer this time. It all depends if they really want to drive construction, infrastructure spending and that sort of thing. Will they start ramping up, particularly steel and other heavy industry outputs like aluminium and that sort of stuff from March onwards? So that's very key to keep an eye on. I'm actually not certain what they will do, to be honest. I think they will want to.
We saw last month they did. Last month, they did sort of show their hand to a certain extent in terms of the easing. We're talking about tightening cycles in Western OECD economies, but the Chinese started the year by easing monetary policy.
Yeah, they have loosened, but it's not. We're not talking huge amounts of money flowing into the system as yet. It's sort of enough to keep things trickling along rather than giving it a big shot in the arm. And I will be waiting very much to start seeing that data from about March onwards, particularly steel output and things like that. If I start to see a lot of iron ore flowing into China from late February, early March onwards, then I'm going to start getting a little more confident that that stimulus is coming, and that will have a flow-on effect with oil. The problem is, the Chinese have historically, if they believe the price to be too high, they're quite prepared to dip into their stockpiles in a way that Western consumers just don't. So they'd be quite happy to run down 100 million barrels of their inventories if they thought that was in their interests. They're not going to stop importing, obviously, but they're not going to import extra and stockpile it. And I think that's the sort of thing that the crude oil market has become used to the fact that China has been buying, up until last year, about a million barrels a day more than it actually was consuming. They got used to that. That was like a fait accompli. And then that kind of stopped last year, where they were more or less in balance. But they are, they have the ability to, dip more into stockpiles, and the willingness to do so that I think is lacking in other major importers. So it's still a waiting game. I would expect that they will continue to import at fairly strong levels.
Well,
whether
whether
it continues, whether it's a big increase, no, I wouldn't see that coming just yet.
We have the other bookend of this year, which is the China National Congress meeting, and in between a zero COVID tolerant policy maintained through to that period. So I would expect that this year might feel a lot like last year in China, where imports might be flat but consume out of inventories. It seems like that kind of a year. Rustin, we seem to have all stopped talking about Ukraine. I know it's been mentioned 2 or 3 times on the podcast this morning, but not in the same velocity of heightened alert that we had a week ago. Is this story over now? Is it? What's your sense in Europe? Is it still one on the front pages of the Zurich Heidekuntung, or whatever the name of the newspaper is there?
I think the Ukrainian story is going to peter out over the next couple of weeks. Putin doesn't have anything really to gain by invading the country. He's allowed the Ukrainians to rearm and bring in more defensive weapons, which would just mean higher loss of life on his side, which doesn't play well back in the back streets of Moscow when you look at the general public. I mean, there's not a lot of incentive or not a lot of public support, I think, in Russia, or for that matter, in Europe and the United States, to have a shooting war over Ukraine.
Does it feel like in Europe that there is one of the major criticisms of this period has been a fractured Europe, Germany not interested, Britain outside of the EU and so forth. Does it feel like over this month or two of this crisis that a consolidated, unified European position has emerged?
I think you still have a bit of a fractured response, because you do have some countries willing to put military equipment into theater, some countries not. So that is a bit different, but I think everybody is aligned that if there is an incursion of any type into Ukraine, there will be sanctions that will come forth and further destroy and destabilize the Russian economy. It will also impact the European economy and the US economy. But nevertheless, I think that is the big enough deterrent that, I like to call it the mutually assured economic destruction, because that seems to be where we're at on brinkmanship. I don't think it's going to be a shooting war. I don't think anybody thinks it's going to be a shooting war. Might there be a covert war? Possibly. But that's already going on, as Russia has had troop type members in Donbas region since 2014, and that hasn't gone away.
And we've seen in recent days, including in our digest today, these sort of cyber attacks across Europe impacting infrastructure. You can imagine where that's coming from. Let's give Carol the last word on the survey result. Okay, big whopping supply concerns here in this room, at least. Carol, your thoughts? I think you started out this morning by saying you were the other way.
No, actually, I did say that there are some supply concerns, Sean, not what is happening in reality. And this is where I want to link it to the last point you were just discussing, that is geopolitics. So at the moment, we cannot rule out potentially a potential escalation on the Ukrainian issue in Europe, or it could lead maybe perhaps to some sanctions on Russia, which is an important producers. The noises we hear, let's say, from some countries, let's say within OPEC, not being able to produce at full capacity. So these are translating into supply concerns. And that's why I think where I see the answer and the interpretation of the survey result. But it's a question of time before seeing whether those supply concerns are actually more tangible than just sentiment. I tend to subscribe to saying that the supply concerns, putting geopolitics aside, are likely to ease off throughout the year because of additional supplies coming to the market. And I would like to conclude with a point I started by talking about earlier on. OPEC plus spare capacity is far from being at historical low levels, as was portrayed in some articles shared earlier today. If you want to know the impact of OPEC spare capacity on the market when it reached really low levels, go to the first decade of the century when it was less than 1% of global supply, and oil demand was increasing rapidly due to genuine economic growth from the BRIC countries, from the emerging economies. That's when we had sustainably higher price, and I don't see that being replicated today, geopolitics aside, of course.
Of course. Okay, well, let's wrap it up there. It's the end of our Middle East week of the Daily Energy Markets podcast. Oil trading just below $90 a barrel. I wonder what it will be when we're back here Sunday morning with the great Mike Muller and Christoph Ruhl to a review on the week past. Where will the price be? Where will equities be? They've had their crash, they've had their rally. What will it be in the end of this week? Maybe some profit taking, perhaps. Clyde Russell, great to have you back at the table. Carol, as always. Rustin, thank you so much. Have a great weekend, everybody. We'll catch you next week every morning, 10:30 UAE time. All the best.
Have a good day, everybody.
Thank you. Bye-bye.